Hello and welcome to a brand new show of Market Makers. It's all about stock picking. Don't look at the Nifty, but individual stocks is where the party is on. How should one read into the current context where everyone is of the view that market valuations are looking stretched, but global and local liquidity will ensure that this rising tide phenomenon will continue? So to talk about markets, valuations, mega trends and big themes, I have with me someone who can he'll be called as a market veteran. Don't go by his looks, but yes, he spent over 30 years researching and analyzing Indian markets and stock prices. Milind Karmarkar, fund manager with Dalal & Broacha, PMS joins us. Mr. Karmarkar, fantastic to have you back and thank you for joining us.
Thank you, Nikunj.
It's been a while, over 2 years.
3 years, I think.
3 years, I guess. Now, markets have changed in last 3 years.
Yeah,
we were discussing,
I don't think, but anyway.
We were discussing China, we were discussing breakup of the European Union.
Yeah.
Today we are discussing liquidity and as if there is no risk in the world.
Well, risks are always there. But as far as India is concerned, I think the market is so small by global standards that and the opportunities are large. So liquidity, I don't think is something which one needs to worry about over a longer period of time. Shorter period of time, probably yes, one would be looking at liquidity, frankly, which I don't. But over a longer period of time, I think liquidity will come in. There is no, because very small liquidity as compared to the global standard is what is required to come into Indian market. So I am not much concerned about liquidity.
So when you buy a stock, when you sell a stock, you don't track what DIs are doing or what FIs could do?
No. Sometimes I wouldn't know at all what is happening.
But that's an important criteria.
For shorter term, it's an important criteria, but as long as you have confidence in the company in which you invest, I don't think you need much to worry about while investing in a company or getting out of the company. Because sometimes after doing all the research, you may go wrong. It's not that you will always be right. So out of 10 stocks, maybe you go wrong in 4. But as long as the 6 stocks which you hold on to over a longer period give you decent returns, I think that's what a winning strategy is all about.
The consensus view is that there is an epic bull run in mid and small cap stocks, but watch your steps. Reality is here, valuations are here. Is that true?
Yes, to some extent it's true, but I'll give you an anecdotal evidence. I was just going through our interviews in 2012 and 2014. So in 2012, we had discussed about a stock. I think it's passed, so I can talk about it without any without any problems as far as the disclosures are concerned. So we were talking about Graha Finance, and you asked me that at 5 times book, isn't it expensive? So from there it has gone up 6 times. And there also I said logic was simple, that if a company is growing at 24% year on year over a longer period, valuations may look expensive at a point, but over a period of time they look cheap, or they look reasonable. Now that can happen, or it can go the other way also. Like we discussed Bata, where frankly the kind of growth which I had expected did not come in. But the business is good, and you just need to be patient and hold on to these businesses, and they deliver over a longer period. So yes, there can be stocks which are expensive at a juncture, but despite that, if the business is good, if the management is good, and long-term opportunity is there, I think one should be buying such businesses.
So you look at growth, you don't look at valuations. Is that what you indicate?
No, I look at valuations after factoring in growth. Let me put it that way. So if a stock looks expensive at the current juncture, I may look at, say, 3 years down the line, like going back to 2012, when you said that Graha Finance is 5 times book, I said that at 24%.
Now, I've been told.
Yeah. So 24% year on year growth. In 3 years' time, the stock would be somewhere around 2.5 times book, and after that it would be at book. But of course, the premium continues. So that is the thing. So growth, yes, you need to factor in growth. Sometimes you may go wrong in factoring in growth. But if, as I said, that if the business is good, you just hold on to the stock. And that is the reason why in my strategy, I normally have a large number of stocks and not focused, say 5 stocks or 7 stocks.
How many stocks do you own in your PMS?
We typically own 20 to 25 stocks.
And how many of these stocks have not changed in last 3 years?
Okay, so between 2000 2007 end and now when we started our portfolio PMS scheme, so that's nearly 9 years. In the earlier accounts who have been with us since 2008, roughly about 75-80% of the portfolio is just the same.
75% of the portfolio is just the
Yeah,
same.
so they contain stocks, what we had discussed in 2012, which we still hold on to.
And you don't think that you're in a hurry to change the heart of your portfolio. But heart of your portfolio is centered around consumption.
Yes, absolutely.
But there are a lot of ways you can bet on consumption. You can bet on retail consumption, which is you buy banks. You can buy staples, which is a direct bet on consumption.
Absolutely.
I can talk about buying a PVR is also a pure bet on consumption.
Possibly, yes.
Or even buying a insurance company's consuction.
Very true.
So let's understand your thoughts on consumption. Why do you like consumption?
Okay, so it's like this, that in the last 30 years, Indian GDP has grown nearly 60 times. And despite that, India's per capita income is just $1,500. Now, suppose it moves from $1,500 to $4,000. Now, if you ask me whether it's possible, we have seen that happening between 2001 and 2007. So, in a short period of time, India's per capita GDP went up nearly 2.2 or 2.3 times. So, it is possible. And every $1,000 increase in per capita would add roughly 75 lakh crores. So that is the reason why consumption is big. And when I'm talking of consumption, as you rightly said, it can be pharma, it can be insurance, it could be retail, it could be hospitals, it could be anything. And the reason is very simple, that all of this requires money. So that is the reason why I think that as per capita income or per capita GDP grows, people will have a lot of more disposable income after satisfying their basic needs. And that is where the growth will come from. I think that will be the driving force for the economy also going forward.
What I've seen over the years is that every market has a seasonal fruit. Every bull market has a mega trend.
Yeah.
I'm working with the assumption that we are in a multi-year bull run. That's what the economy and that's what the indicators are indicating. So what do you think could be the leader or the mega trend of this bull run?
Consumption.
Again consumption.
Again consumption. Okay. I mean, it's become a cliche.
It is not economic recovery, it is not cyclicals, it is not the fact that Indian economy will recover and you will not bet on capex recovery. So you're not playing the cyclical end of the market.
Okay, so let me put it this way, that as far as I know, so 30 years, every time there is a big bull market. So I have seen 3 such markets. Every time there is a sector which drives the economy. Like in 2003 to 2008, which most of the people know, it was engineering and infrastructure companies. So I think this time it will be the increasing per capita income which will drive. That doesn't mean that these companies won't grow. These companies will also grow, but they probably would be market performers or maybe slight market outperformers. But the real drive will come out of consumption-driven stocks.
How are you betting on consumption? Are you buying hospitals? Are you buying retailers? Are you buying something else which we don't know?
Again, I can tell you, I don't know whether I can tell you what I'm buying, but I can tell you what I like overall. Again, this is not advice to anyone because I need to be very careful because of
disclosure norms are there and we respect that.
Yes. So I like anything in consumption, but I like retail, you already know that. I like hospitals, I like insurance companies. Some of them, as you say, could be looking expensive from the current valuations. But yes, I think they have got a huge scope for growth. That is the reason why I like hospitals, insurance companies, pharmaceuticals, retail space, or even something in white goods, which also could be interesting.
Okay, so let's look at all these, subcategories one by one.
Yeah.
I'll start with retail.
Okay.
DMart has got listed.
Yes.
It made all the right headlines.
Correct.
But along with the right headlines, there was a warning, which is that watch the valuations.
Correct.
Why do you think organized retail in India, which is a very well discovered sector, there's nothing great or sexy about that business because margins are wafer thin, can create a lot of wealth? And especially you're bullish on organized retail when there is a world called Amazon, a company called Amazon, which is disrupting everything.
Correct. Now, there are 2 things to it. If you read the news, I'm sure you would. I mean, it's wrong for me to say that. But Amazon is also going into brick and mortar. So, Amazon is setting up its own stores as well. So, I think Amazon also understands that you need to have a brick and mortar store. And I'm sure Indian promoters also understand that they need to have a presence on the net also. So as far as food and grocery is concerned, I think that internet will only be one more way to deliver your goods or to order goods. I have been talking to these people over this for quite some time, and what answer which I get is interesting. They say that frankly it is more expensive to deliver goods via an online order rather than a customer coming to your place and taking it himself. But having said that, I think most of the food and grocery stores will also need to have a presence online, and that is what will happen. So I am not worried that everyone will only, there will be only one model like Amazon which will work. It will be a combination of click and mortar, as they say.
So you're happy to buy the 2-3 retail stocks for next 5 years?
Yes, definitely.
Are you happy to allocate 15% of your portfolio only to retailers?
I don't know, because there are not many retailers where the opportunity is there, and I am a risk averse person. So I normally distribute, as I said, my risk over 20-25 stocks. So yeah, there will be a couple of stocks which will be there in this portfolio, or maybe 3 stocks. So yeah, 15% could be the percentage to look at.
Years ago there was only one listed hospital.
Yes.
And
yes.
That was the compulsion. Now you got 4 or 5 listed hospitals.
Correct.
How should one pick and choose which is the best hospital? Because if you read the website of any of the hospital, they talk about we are committed to service and we are committed to service for free. But economic reality is very different.
I think you should look at those hospitals which are lowest cost service providers, and you should be. So I looked at a hospital where my initial question, the first question to the management was that, are you for charity or are you for business? So once I got a clarity that they were indeed for profit, but this hospital said that the profit was not out of raising the top line, but by focusing on costs. That's what something which I liked. And I think as long as hospitals, you have such type of hospitals, I think these would be the hospitals which would be winners over a longer period of time. Again, hospital is very similar to retail business. If you remember way back when we looked at Trent, there was no ROC because they were on an expansion phase, and there was a lot of money which went into expansion. Same thing is true with hospitals also. But once when the number of operating beds increase as compared to the new investments, then these hospitals start making profits, their ROCs would go up. And so for a longer term, I think these hospitals could be really interesting, because again, it's a play on increasing per capita income as well as spread of insurance.
That's really the most important factor and the differentiating factor, that now healthcare is becoming affordable.
Correct.
Okay. Now, you like healthcare and you also like insurance.
Yeah.
They both are tying in together because it's a direct play on consumption.
Correct.
There are only 2 listed insurance companies in India.
So
not large to choose from.
Very true. That's true, but I'm sure many more will come in. I would rather go in for an insurance company which is not into ULIPs. Well, ULIPs, I think, is not something which is good for a consumer. And I would go for anything which is good for consumer, because over a longer period of time, I think what is good for consumer works.
Fair point. Let's talk about HFCs. And you talk about growth and consistency. We can draw a straight line and talk about a 20% growth for HFCs is coming. But let me take a leaf of when I interviewed Howard Marks a couple of months ago, and he said that when an asset class gets a popular nickname, the pricing is not favorable. And with the entire HFC sector, the comfort factor is just too high. Correct. Every brokerage, every fund manager, maybe they are being lazy, but they are advocating that you should buy HFCs. So HFCs could be great businesses.
I agree.
Are these good stocks to buy?
HFCs, as you rightly said, have become very expensive. So you need to be extremely careful. New HFCs can have an issue over a longer period of time. One doesn't know. So ideally, I think one should look at HFCs which have been in the business for a long period of time, and despite that have very low NPAs. I think those would be the housing finance companies which you should go for. But if they are very expensive, I would rather avoid that sector completely, because I agree with you that it's getting overcrowded, and at a stage there could be a shakeout.
Are you tempted to relook at any of the staple names? Because that again, because of GST, will be the biggest beneficiary. That sector would be the biggest beneficiary.
Well, I already have a staple, you know, that we have discussed about it earlier. So I continue to hold that, and yes, staples is something which I like. So not large listed companies, Britannia is the only one which we have talked about earlier. So once again, I want to clarify again and again that it's not an advice.
We're just discussing the merits and the demerits.
So again, it's on increasing per capita income. You have more money to spend, it will go in these things. So I think yes, I will continue to buy staples.
You know, investors, they always hunt for fear, and right now I can smell and I can see fear in pharma. There is a serious price damage which has already happened to IT. These are great businesses. I mean, India has an advantage there, size, skill, scale, and yet these stocks are getting stepmotherly treatment. Are you hunting in that pond?
Yes, of course. I like pharma, and what has happened is probably because there were certain issues in quality. I am quite sure about it, because US FDA, I don't see it as a sort of a, initiated action with vengeance or something like that. It doesn't look like. Probably there were issues which, especially in the processes which these companies followed, because US FDA also talks about following the process to the T. So that is where the problem has been coming in, and most of them have started rectifying that. So I don't see a significant worry about what's going to happen in pharma now that the valuations have also corrected, and you rightly said these are great businesses. And India, again, the opportunity is huge. There is huge opportunity for exports as well. So as long as they get their act right, they get their quality controls in place, they get their processes in place, I think these businesses will grow over a longer period.
You know, when I started my career, the definition of top 3 pharma companies were Ranbaxy, Sun Pharma, Cipla, and Dr. Reddy. After 17 years also, those names have not changed. So the bottom line here is that large guys understand the business and they understand the cycles and the risk. So should one just stick to 2 or 3 top pharma names, 2 or 3 top large cap pharma names?
Yes, you can look at, because by global standard they are still very small companies. So opportunity, their growth opportunity can be really big. And coming to the opportunity, I still remember long back in 90s, once I had met Dr. Reddy himself, and I was asking him what is the trigger. So he said increasing per capita income. I still remember that. So that is the reason why I have been continuously bullish on pharma in India, and I think they will do well. And as I said, that these large cap companies by global standards are still small caps.
So is one better off looking at pharma companies, and especially MNC pharma companies which are inward looking? When I say inward looking, which get bulk of their revenue and profit by selling drugs in India?
The problem with MNC pharma companies has been that they are very slow in introducing new drugs because of their patent restrictions. And that is the reason why the growth in in MNC pharma companies of late has not been as much as the Indian pharma companies. So I would rather stick with Indian pharma companies.
Now you always talk about the size of opportunity. Always look at the size of the opportunity and then make your scenario analysis. The size of opportunity in IT is also very large.
Yes.
There is artificial intelligence, there is Internet of Things. We can talk about data analysis and analytical business. Cloud is the word which everybody seems to be talking about. How does one capitalize on this so-called new digital highway?
Currently, the issue is that the largest consumer of IT services has been the United States, and there has been some issue in the United States. So it's likely that generally IT services companies will remain subdued for some time. That is one. Second is that most of these companies have not been frankly innovating big time. So they need to change their business model. So whosoever changes the business model in the next 1 or 2 years, those would be the winners. I mean, even the large ones have already started talking about it. So I'm sure some leader will emerge, but one will have to keep one's eyes and ears open.
But you're not a buyer in large cap IT.
I'm not a buyer in
even though these are cash rich companies.
No. I'm not.
What you're not fascinated with the fact that they're paying a lot of cash back, return on equity, return ratios, which have been subdued?
No,
by
I
some
look
change?
at businesses, and I look at businesses which large growth potential. So somehow that they don't fit in that category as of now, at least. So that is I think it has become a mature business. So when a business becomes mature, probably it will be a good dividend, return stock. But as a growth opportunity, I don't see there. At
So-
least not as of now. If they change the business model, maybe I'll look at it.
We are interacting almost after 3 years, and hopefully next time we interact much more before that. But if you work with the assumption that we are interacting in 2020,
Yeah.
which are the 3 categories you think will be significantly bigger and larger?
Pharma would be one, hospitals would be there, and retail would be third.
So you're happy to mount your portfolio on these 3 things?
Yeah.
And you don't think that large part of your portfolio next 3 years is going to change significantly?
No, I don't think
What
so.
forces you to sell a stock?
A mistake, one. So I was bullish on a financial company, I wouldn't name that, which was specifically in renewable energy. It's a finance company in renewable energy. At that point of time, that was the only company. In last couple of years, because of the issues with industry, lot of banks have moved into that space. And because of that, their NIMs are under contraction. The opportunity is large, but at the same time, the players who are willing to give loans have also become larger. And because of that, the company is finding it difficult to grow at the same pace at which it was going earlier. In addition to that, in case of renewable, the prices have fallen drastically. And that makes it difficult for them, for the earlier companies to, start paying on a regular basis. And that is the reason why I thought that it was time to get out of that company. So sometimes the environment changes, it's no fault of the company, but because of the change in environment, the growth may not be possible going forward, at least in next 5-6 years, then I would like to shift. Second time, sometimes it's a genuine mistake. So because after doing all the due research, despite that, you may end up at least 20-25% of the time that you go wrong on a call. So you sell it, otherwise you don't sell.
So you're happy to own stock for years?
Yes.
And the short-term volatility, the short-term valuation uptick or downtick, that doesn't excite you or disappoint you?
No, it doesn't. I wouldn't say it does disappoint, because if you if a particular company has not performed despite the market performing, it hurts somewhere. It's not that it doesn't hurt, but at the same time, I won't decide to sell a stock only because it has not performed for 2 quarters, 3 quarters, even for 1 year, 1.5 years, as long as there is genuine reason for that.
Is the core of investing changing now? I mean, Buffett is now talking about, look, I did a mistake because I did not buy Google or Amazon. What I'm trying to understand from you is that, long haul investors like you don't look at short-term market,
Yes.
variation. You look at the mega trends. But is that old school investing now?
I don't think so, because what Warren Buffett was probably saying was, I missed thinking, I missed realizing that Amazon can be such a big business or Google can be so successful. So I think that is what he's saying. He's not saying that my my style was wrong.
So buy and hold is still here to stay.
Obviously, especially in a country like India where per capita income is $1,500, I would say it is.
So just for the benefit of those who watch this show regularly, if they have to really learn from your mistakes and from your experience, what would you advise them?
I would say that invest for long term, but at the same time be focused on what is happening around. Has the environment changed? If the environment has changed, then you need to take a quick call and get out of a particular company which you are holding for long term, irrespective of the fact whether you are making a profit or you are making a loss.
One closing comment, if you have to summarize our today's interaction, you said that look, buy and hold.
Yeah.
But it is also important to time the buying. If you would have bought at the peak of 2000, you would have lost 50% in your portfolio.
Yeah.
If you would have bought in 2003 or 2004, you would have made an automatic return of 100% in next 2 years.
Yeah.
So if you have to talk about market cycles, where do we stand right now?
Okay, I'll again say that in last 9 years, market has gone up about 70% roughly, while as the GDP has grown more than 100% or around 90%. Typically, market grows say 1.25 times the GDP, which it has not done, and it is likely to do going forward. So I don't think that market is at its peak. I think that the bull run has just started. and there is enough opportunity for growth. But I believe in individual businesses. So as I always say that there are three things: buy good businesses with decent management at reasonable price. But when I say reasonable price, it's reasonable price after considering growth. So despite considering growth, if reasonable price is not there, then ideally I would say wait for it to come, because cash also is an asset.
But you're fully invested in this market.
Yeah. Okay, let me put it this way, that for the newer new money which comes to me, I am about 40-50% invested.
Which means you're expecting markets to come down.
I don't see markets I don't think markets may or may not come down. I don't know really. I am looking at opportunities. So if I get some, because I keep on meeting companies, so if I get a good company, I'll invest.
Appreciate your time, sir, and thank you for joining us.
Thank you so much,
This edition of Market Makers. Thank you for tuning in. Thank you for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.